The S&P 500 is one of the greatest investment products ever created. That is where I would begin. Not with excitement, not with a promise, not with the fantasy that you can easily beat the market every year. The starting point has to be respect for the base case. For a long-term investor, the S&P 500 represents ownership in many of the largest and most productive companies in the United States. It has survived wars, recessions, inflation, crashes, political shocks, banking problems, technology cycles, and many periods when people were certain the future was broken. And yet, over long periods, it has produced powerful returns. That is why the S&P 500 is the benchmark. But here is the question that matters. What happens if you can do just a little bit better? Not double your money every year, not chase a 200% return, not gamble on one stock, just a few percentage points better over a long enough period. Most people underestimate what that means because the human mind does not naturally understand compounding. We think in straight lines, money compounds in curves. A small return difference for 1 year may not feel meaningful. A small return difference for 30 years can change a life. Imagine you invest $10,000 one time and never add another penny. At a 10% annual return, which is close to the long-term average often associated with the S&P 500. That $10,000 can grow to about $26,000 over 10 years. That is good. But if the return is 13%, the same $10,000 grows to about $34,000 over 10 years. If the return is 15%, it becomes about $40,000. If the return is 17%, it becomes about $48,000. At first, the difference may not feel large enough to change how someone thinks. The person may say, yes, 48,000 is better than 26,000, but it is not life-changing. But that is only 10 years. Stretch the timeline to 30 years, and the math becomes very different. At 10%, $10,000 can become roughly $174,000 at 13%. It can become roughly $395,000 at 15%. It can become roughly $662,000 at 17%. It can approach roughly $1.1 million. Same starting point, same $10,000, different compounding rate, completely different result. This is why small advantages matter. A few percentage points do not feel dramatic in year 1. They do not even feel dramatic in year 5. But over 30 years, those few points can create a difference between ordinary wealth and extraordinary wealth. This is one of the most important lessons in investing. You do not need magic, you need time, discipline, and a system that can compound at a strong rate without forcing you into emotional mistakes. But there is a second principle that must come immediately after the first: higher potential. Returns usually come with higher risk. There is no free lunch. If you try to beat the S&P 500, you are usually accepting more concentration, more volatility, more sector exposure, more valuation risk, more cycle risk, or more behavioral risk. That does not mean you should never try. It means you must understand the trade-off. The investor who does not understand risk will eventually be controlled by it. So the correct question is not simply, how do I beat the S&P 500? The better question is, what type of additional risk am I taking, and can I live with that risk through bad periods? That is how a serious investor thinks. The S&P 500 gives broad exposure. It owns a large group of major companies. When one company weakens and falls out of the index, the system eventually replaces it with a stronger or larger company. The investor does not need to personally manage every business. The fund does the sorting. That is one of the reasons the S&P 500 works so well for ordinary investors. It gives diversification. It gives automatic rebalancing at the index level. It gives participation in the productivity of large American companies. It keeps the process simple. Simplicity is valuable because the biggest enemy of most investors is not lack of intelligence. It is bad behavior. They panic sell during crashes. They chase after rallies. They move from one idea to another. They buy what recently went up and sell what recently went down. They confuse volatility with danger and comfort with safety. They have no plan. A broad S&P 500 index fund helps protect against some of these mistakes because it is simple enough to hold. But if someone wants to attempt to outperform the S&P 500, they must understand what they are doing. They must know why the fund could outperform, why it could underperform, and what environment would make the strategy painful. That is the foundation. Now, the first way to attempt to outperform the S&P 500 is to focus on growth. A growth-focused ETF such as VUG gives exposure to companies with higher growth characteristics. The logic is straightforward. Instead of owning the entire market equally according to the broad index, you emphasize companies that are growing faster. Over the last decade, growth companies have often done very well, but growth is not always superior in every environment. Growth can underperform when interest rates rise, when valuations compress, when investors rotate into value, or when future earnings become less attractive relative to present cash flows. This is why growth investing must be understood clearly. Growth stocks often derive much of their value from future earnings. When the cost of capital is low and investors are optimistic, the market may be willing to pay high prices for future growth. When rates rise or uncertainty increases, those future cash flows may be discounted more heavily, and growth stocks can fall harder. So a growth ETF can outperform the S&P 500 over certain periods, especially when innovation, technology, and earnings acceleration are leading the market, but it can also be more volatile. The investor must be able to hold through that volatility. This is a recurring pattern. The fund that gives you a chance to beat the market often gives you a chance to feel worse than the market during downturns. If you cannot hold it when it underperforms, then the theoretical return advantage does not matter. The second ETF category is technology, represented by XLK. This is more concentrated than the broad market. It focuses on technology companies inside the S&P 500. Over the last decade, technology has been one of the strongest engines of market returns. Software, semiconductors, cloud computing, digital platforms, mobile ecosystems, artificial intelligence, and enterprise technology have changed the economy and created enormous profits for leading companies. This is why a technology sector ETF can outperform. It concentrates capital in one of the highest growth parts of the economy, but concentration is both the advantage and the risk. The S&P 500 owns technology, but it also owns healthcare, financials, consumer staples, industrials, energy, utilities, and other sectors. XLK narrows the bet. If technology continues leading, the fund can do very well. If technology valuations become too high or the sector faces a long period of underperformance, the fund can lag or fall harder. This is not a reason to avoid it automatically. It is a reason to size it properly. A technology ETF should not be treated like the entire economy. It is a sector bet. Even if the companies inside it are large and important, it is a way to tilt the portfolio toward a specific belief that technology will continue to produce above average growth and profitability. If you believe that, and if you can tolerate the volatility, XLK-style exposure can make sense as part of a broader strategy. But do not confuse a sector tilt with a risk-free upgrade. There is no such thing. Now, the third area is aerospace and defense, represented by an ETF such as PPA. This is a different kind of exposure. Defense companies do not depend only on consumer excitement or discretionary spending. They often depend on government budgets, military contracts, geopolitical tension, defense modernization, satellites, missiles, aircraft, cybersecurity, and national security needs. That makes the sector structurally different from many others. Defense spending can continue even during weak economic periods because governments prioritize security. If geopolitical tensions increase, defense budgets may rise. If countries feel less safe, they often spend more on military readiness. This creates a durable demand base for certain companies. But defense investing also has a moral dimension. Some investors are comfortable owning defense companies, others are not. This is personal. A good investment must make financial sense, legal sense, and moral sense for the person making the decision. I cannot give someone their moral compass. I can only explain the mechanics. From a financial standpoint, aerospace and defense can offer exposure to government-backed demand and geopolitical spending cycles. From a moral standpoint, each investor must decide whether they are comfortable profiting from that industry. That is a real decision. Markets are not separate from values. You can choose to exclude industries from your portfolio if they do not fit your principles. But you should do it consciously, understanding both the financial trade-off and the personal reason. A portfolio should not only reflect expected returns, it should also be something you can live with. Now, the fourth ETF is a momentum strategy, such as SPMO. Momentum is based on a simple observation. Assets that have been rising strongly can sometimes continue rising because trends persist. Money flows into winners. Institutions add exposure. Indexes and funds buy more. Positive price action attracts attention. The trend reinforces itself until it does not. A momentum ETF attempts to own the companies in the S&P 500 that are showing the strongest price momentum. This can outperform in certain environments because markets often trend. Winners can keep winning longer than people expect. But momentum can also reverse sharply. A stock that rises because everyone is buying can fall quickly when the flows shift. That makes momentum more behaviorally difficult. It is still tied to large S&P 500 companies, which may reduce some extreme risks compared with small speculative stocks, but the strategy is inherently more dynamic. It buys strength, it may rotate, it can look brilliant during sustained trends and painful during reversals. Momentum is not the same as long-term fundamental investing. It is closer to a systematic way of capturing trend behavior inside the market. If an investor owns a momentum ETF, they must understand that the strategy can change its holdings and may be more sensitive to market shifts. It is not something to panic sell just because it has a weak period. Like any strategy, it must be held with an understanding of its role. The fifth ETF is SMH, focused on semiconductors. This is one of the most powerful areas of the last decade because semiconductors are the foundation of modern technology. Phones, cars, data centers, artificial intelligence, cloud computing, defense systems, medical devices, industrial equipment, and advanced manufacturing all depend on chips. If software is the brain of the digital economy, semiconductors are the physical nervous system. Artificial intelligence made this even clearer. AI requires enormous compute power. Compute requires advanced chips. Data centers require GPUs, memory, networking, power systems, and specialized semiconductor supply chains. When demand for AI infrastructure accelerates, semiconductor companies can benefit enormously. That is why a semiconductor ETF can dramatically outperform during a chip cycle. But the same rule applies: high return potential comes with high volatility. Semiconductors are cyclical, supply and demand can swing. Capital expenditure can rise and fall. Geopolitics matters because chip supply chains are globally sensitive. Valuations can become stretched. If AI spending slows or expectations become too aggressive, the sector can correct sharply. So SMH-style exposure is not simply a better SP 500. It is a concentrated bet on one of the most important industries in the world. That can be powerful, it can also be painful. The correct approach is not to ignore the opportunity, but to respect the volatility. Now, there is also a broader technology-heavy option, QQQ. The Nasdaq 100 gives exposure to the 100 largest non-financial companies listed on the Nasdaq. Because many of these companies are technology or technology-adjacent businesses, QQQ has historically offered a strong growth tilt. It is broader than a pure semiconductor ETF and less narrow than a single sector like chips, but it is still more technology-heavy and more volatile than the SP 500. That is its nature. When growth and technology are leading, QQQ can outperform. When the market rotates away from high-growth companies, it can fall harder. During market booms, it may move faster than the SP 500. During crashes, it may decline more sharply. This is the trade-off. More upside sensitivity, more downside sensitivity. Many investors want the upside but do not understand the downside until it arrives. That is a problem. A fund like QQQ can be a strong long-term holding for someone who believes in the continued dominance of major technology and growth companies, but only if they can tolerate volatility and avoid selling during crashes. That is the entire game. A good ETF held through bad periods may compound wealth. A good ETF sold in panic can become a bad outcome. The asset matters, the behavior matters more. Now let's pull back and look at the structure. VUG emphasizes growth. XLK emphasizes technology. PPA emphasizes aerospace and defense. SPMO emphasizes momentum. SMH emphasizes semiconductors. QQQ emphasizes large non-financial Nasdaq companies, mostly technology and growth. Each of these has historically beaten the SP 500 over certain periods, but each did so by taking a different kind of risk. Growth risk, sector concentration risk, geopolitical and defense exposure, momentum reversal risk, semiconductor cycle risk, technology concentration risk. This is how you should think. Do not ask only which fund had the best historical return. Ask what caused that return. Ask whether the cause can persist. Ask what would make it fail. Ask how much volatility you can tolerate. Ask whether it belongs as a core holding, a satellite holding, or no holding at all. This is portfolio construction. Most investors do not do this. They look at a return chart and buy the line that went up the most. That is not analysis, that is chasing. A line that went up the most may be the best opportunity, or it may be the most overextended risk. You need a framework to tell the difference. Past performance does not guarantee future performance. That phrase is repeated so often that people stop hearing it. But it is one of the most important truths in finance. An ETF that returned 33% annually over the last decade does not owe you 33% annually over the next decade. The next 10 years may have different interest rates, different valuations, different competition, different regulation, different margins, different supply chains, and different investor expectations. The question is not what happened. The question is whether the forces that created what happened are likely to continue and whether the current price already reflects too much optimism. That is the hard part. For example, semiconductors have benefited from AI demand. If AI infrastructure spending continues to grow aggressively, semiconductor exposure may continue to benefit. But if expectations are already extremely high, the stocks can fall even if the companies continue growing. Markets price expectations, not just reality. A company can report good results and still fall if investors expected great results. That is why valuation and expectations matter. The same applies to technology, momentum, growth, defense, and Nasdaq exposure. Now, the strategy discussed in the source is not only about which ETFs to own, it is also about how to behave. The phrase was always be buying. The idea is simple. If you believe in the assets you own and you are investing for the long term, then you keep investing consistently through different market environments. Markets up, you buy. Markets down, you buy Republican president, you buy Democratic president, you buy recession fears, you buy economic boom, you buy inflation headlines, you buy rate cut headlines, you buy. The reason this works is not because every day is a good day to invest. The reason it works is because you cannot predict which days are best. A consistent system removes the need to make perfect timing decisions. This is very important. Most people lose money not because they chose a reasonable ETF, but because they stopped buying during the best opportunities. Market crashes and recessions feel terrible in real time. But historically, they have often been among the best times to buy high-quality broad assets. The problem is that most people do not have cash, courage, or a system when the crash arrives. They panic, they sell, they wait for clarity, then the recovery comes before clarity. This is why the second phrase matters, BTD, buy the dip. But this phrase is also dangerous if misunderstood. Buying the dip only makes sense if you are buying an asset you want to own long-term and if your financial life can support the purchase. Buying the dip in a bad asset can be throwing money into decline. Buying the dip with money you need soon can be dangerous. Buying the dip without an emergency fund can create fragility. So the principle is not blindly buy everything that falls. The principle is that when high-quality assets you believe in fall because of market cycles, and if your system is strong, you can buy more aggressively. That is how downturns create wealth. A 20% decline means you can buy the same asset at a 20% lower price. A 34% decline means you can buy more ownership for the same dollars. A 50% decline is terrifying, but for an investor with cash discipline and time, it can be one of the greatest opportunities. This is why cash reserves matter. Not excessive cash forever. Strategic liquidity. You need money to buy when markets fall, and you need emergency cash so you are not forced to sell when markets fall. That is the difference between a strong investor and a fragile investor. The strong investor sees a crash as a future return opportunity. The fragile investor sees a crash as a liquidity crisis. The same market event, different personal balance sheet. Now, let us discuss the investor's biggest weakness. Emotion. When markets go down, people feel fear. They imagine the decline continuing forever. They read headlines. They watch their account fall. They think selling will stop the pain. They tell themselves they will buy back later when things are clearer. But later is usually not clear. Later is either higher, which makes them feel they missed it, or lower, which makes them more afraid. The market does not provide emotional comfort at the right time. That is why pre-commitment matters. Before you invest in any ETF, ask yourself whether you can hold it through a 30 to 50% drawdown. This is not theoretical. Broad markets can fall, technology can fall more, semiconductors can fall harder, momentum strategies can reverse, growth can underperform for long periods. If you cannot hold through that, the fund may be too aggressive for you, even if the historical return looks attractive. The best portfolio is not the one with the highest expected return on paper. It is the one you can actually stick with. This is another principle people ignore. They design portfolios for the person they wish they were. Then a crash reveals who they actually are. A portfolio must be built for your real behavior, not your imagined courage. Now, how might someone use these ETFs intelligently? One possible approach is core and satellite. The core could remain broad diversified exposure such as the S&P 500 or a total market fund. That is the foundation. Then the satellite positions can tilt toward areas where you believe there is a reasonable chance of higher long-term growth, such as technology, semiconductors, growth momentum, defense, or QQQ. This approach prevents the investor from making one concentrated bet while still allowing for potential outperformance. For example, someone may keep most of the portfolio in broad market exposure and allocate smaller portions to SMH, XLK, QQQ, or other tilts. The exact allocation depends on age, risk tolerance, income, time horizon, tax situation, and personal conviction. The key is to avoid turning every idea into a large position. A sector ETF can outperform dramatically, but if it becomes too large and then falls sharply, the investor may panic. Position sizing is emotional risk management. Another approach is to use these funds only as examples of what drives outperformance. Instead of buying them all, you study them. You learn that growth, technology, defense, momentum, and semiconductors have been powerful drivers. You then decide which, if any, fit your beliefs. Maybe you only choose one, maybe you choose none, maybe you prefer the S&P 500 and sleep better. That is perfectly valid. The goal is not to force complexity. The goal is to understand trade-offs. Many people should simply own the S&P 500 and keep buying. That may be enough. In fact, for many investors, trying to beat the market is what causes underperformance because they jump in and out, chase past winners, and sell during pain. The S&P 500 plus discipline can outperform a complex portfolio with bad behavior. That is not a small point. Complexity is not intelligence. Sometimes simplicity wins because it is durable. But for someone who wants to pursue slightly higher returns and accepts the risk, these ETF tilts are tools. A tool is useful only when used properly. Now, let's analyze each fund from the perspective of long-term belief for growth exposure. The belief is that faster growing companies will continue to generate superior earnings and investor demand over time. The risk is valuation compression and underperformance during value-led or high-rate environments. For technology exposure, the belief is that technology remains central to productivity, corporate margins, software, platforms, AI, and digital infrastructure. The risk is sector concentration, regulation, valuation, and cyclicality. For defense exposure, the belief is that geopolitical conflict, national security spending, and military modernization will continue regardless of economic cycles. The risk is political changes, budget shifts, execution problems, and moral discomfort. For momentum exposure, the belief is that market trends persist and systematic exposure to winners can outperform. The risk is sharp reversals and buying assets after large runs for semiconductor exposure. The belief is that chips remain essential to AI, cloud, vehicles, defense, medical devices, and the digital economy. The risk is cyclicality, supply gluts, geopolitical concentration, and valuation for QQQ. The belief is that the largest non-financial Nasdaq companies will continue compounding earnings and dominating markets. The risk is concentration in expensive technology and growth companies. Each belief must be tested. What if rates stay high? What if AI spending slows? What if defense budgets shift? What if technology regulation increases? What if valuations fall? What if another sector leads the next decade? If your thesis cannot survive these questions, it is not a thesis. It is a preference. Now, the source also made a point about the market cycle. Over the last century, the economy has experienced many recessions and many market crashes. Yet the broad market has continued to compound over long periods. This matters because many investors behave as if recessions are surprising. They are not. They are part of the system. Market crashes are not bugs. They are features of a risky asset market. If you invest in equities, you should expect declines. If your strategy depends on markets never falling, it is not a strategy. It is a fantasy. The better approach is to plan for crashes. Have cash reserves, keep debt manageable, invest automatically, rebalance. Buy more when the assets you believe in are discounted. Do not use money needed in the next few years for volatile investments. This is how you turn volatility from an enemy into a tool. Most people do the opposite. They spend all their cash in good times. They feel confident near market highs. Then the crash comes. They have no reserves. They panic. They sell. They miss the recovery. Then they buy back when the market feels safe again. This cycle repeats. The market rewards the people who can do what is emotionally difficult. Buying when everyone is calm is easy. Buying when everyone is afraid is hard. That is why it works. Now, let's think about retirement speed. The title suggests that beating the S&P 500 could help someone retire 10 years faster. The math behind that idea is compounding. If you earn a higher return over decades, you can reach the same wealth target earlier. That is true. But there is a risk in framing it too aggressively. If someone hears retire 10 years faster and then takes too much risk, the plan can backfire. A higher return portfolio with higher volatility can lead to panic selling, poor timing, or concentrated losses. A person who cannot hold the strategy may retire later, not earlier. So the correct principle is this: higher returns can accelerate retirement only if the strategy is sustainable. Sustainable means the investor can fund it, hold it, understand it, and survive its drawdowns. A 15% return that causes panic selling during a 40% decline is not a 15% return for that investor. It is a behavioral trap. A 10% return held consistently may beat a higher return strategy abandoned at the bottom. This is why the investor's psychology is part of the return equation. The market does not give you historical returns simply because you buy the ticker. You have to hold through the historical experience that includes the crashes. Now, the role of automatic investing is powerful here. If money leaves your checking account every week or every month and is invested into your portfolio, you reduce the need for constant decisions. You create a system. The system buys during rallies and during declines. It buys when headlines are good and when headlines are bad. This is dollar cost averaging. It is not guaranteed to produce the highest mathematical return compared with investing a lump sum in every scenario, but it is psychologically powerful. It turns investing into a habit rather than a forecast, and habits are what build wealth. The investor who relies on mood will be inconsistent. The investor who relies on systems can compound. That is why automatic investing is one of the best tools for ordinary investors. Now, there is another lesson in the source that deserves emphasis. Do not blindly trust a random person on the internet. That includes anyone: a YouTube creator, a newsletter writer, a financial commentator, a friend, a relative, even someone who sounds confident and gives numbers. You can learn from people, but you must own your decisions. Investing involves risk. You can lose money. Past performance can fail. A fund that outperformed for 10 years can underperform for the next 10. A sector that looks inevitable can disappoint. The person giving the idea does not live with your consequences. You do. So use ideas as inputs, not instructions. Study the fund. Read the holdings, understand the expense ratio, understand the sector exposure, understand the drawdowns, understand the valuation, understand the role in your portfolio. If you cannot explain why you own it, you probably own it too casually. Now, let's consider fees again, because ETFs generally solve one problem that active funds often create. Low-cost ETFs can give broad or targeted exposure with relatively low fees. This is one of the great advantages of modern investing. You do not need to pay 1% or more to get exposure to a sector or factor. You can buy many ETFs at low cost, often through ordinary brokerage accounts, but low fee does not mean low risk. An ETF can be cheap and volatile. SMH can have a reasonable expense ratio and still fall sharply in a semiconductor downturn. QQ can be efficient and still experience large drawdowns. XLK can be low cost and still be highly concentrated. Fee is one variable, risk is another. A good investor looks at both. Now, what would a disciplined long-term ETF strategy require? First, choose the core. For many, the core may be the SP 500 or total market. This is the base of the portfolio. Second, decide whether you want tilts. Do you believe technology, semiconductors, growth defense, momentum, or Nasdaq exposure will outperform? If yes, how much are you willing to allocate? Third, define the maximum allocation. Do not let a hot sector become the whole portfolio unless you fully understand and accept the risk. Fourth, automate contributions. Always be buying works only if it is consistent and affordable. Fifth, maintain cash reserves. This allows you to avoid selling during emergencies and potentially buy during downturns. Sixth, rebalance. If a tilt becomes too large after strong performance, consider trimming back to target. If a tilt becomes too small after a decline, but the thesis remains intact, consider adding. Seventh, ignore noise. Fed headlines, elections, recessions, oil, wars, inflation, and crashes will all happen. The plan must be built to survive them. Eighth, review annually. Make sure the fund still does what you think it does. ETF holdings and sector exposures can change. Your life can change, your risk tolerance can change, your time horizon can change. This is a system, and systems beat impulses. Now, there is an important difference between investing and trading. Momentum ETFs blur the line a little because they use price trends as a factor, but the ordinary investor should still approach them with a long-term plan if they are using them as part of a portfolio. Constantly moving in and out based on recent performance can create poor results. The investor must know what game they are playing. If you are a long-term investor, your edge is time, discipline, contributions, tax efficiency, and behavior. If you are a trader, your edge must come from timing, information, execution, and risk management. Most people think they are investors until volatility turns them into traders. That is dangerous. Decide the game before you play. Now, why might these ETFs continue to matter? Growth remains important because the economy rewards companies that can increase earnings and reinvest at high rates. Technology remains important because digitization, AI, cloud, software, and automation continue shaping productivity. Defense remains important because geopolitics is not disappearing. Momentum remains important because markets tend to trend when capital flows concentrate. Semiconductors remain important because chips are the foundation of the digital and AI economy. The Nasdaq 100 remains important because many of the world's strongest companies sit there. Those are reasonable long-term arguments, but reasonable arguments are not guarantees. The future can surprise you. Maybe value stocks lead, maybe international markets outperform, maybe commodities become more important, maybe regulations pressure technology, maybe defense spending slows, maybe semiconductor supply exceeds demand, maybe valuations compress for years. That is why diversification matters. A good investor does not need to be certain. A good investor needs to be resilient. Now let's talk about the psychological danger of back-tested returns. When people see that an ETF returned 1821 or 33% annually over a decade, they often imagine the future will look like the chart. They do not imagine the drawdowns, the doubts, the years of underperformance, the fear, the headlines, and the temptation to switch strategies. A chart smooths pain. Living through the chart is different. This is why looking only at the ending return is not enough. You must look at the maximum drawdown. You must look at years of underperformance. You must look at volatility. You must ask whether you could hold through it. If you cannot, the return is not available to you. The return belongs only to the investor who can survive the path. This is perhaps the most important lesson in long-term investing. The path matters. Now consider the difference between someone who invests one time and someone who invests every month. The one-time investor depends heavily on starting valuation and timing. The monthly investor keeps adding capital. This can reduce timing risk and create opportunities during declines. If the market falls, new contributions buy more shares. If the market rises, the existing portfolio grows. This is why consistent contributions are so powerful for working people. Your paycheck becomes the engine, the market cycle becomes the opportunity. Your job is to keep the system running. If you increase contributions as your income rises, the compounding becomes even stronger. The greatest wealth builders often combine strong returns with high savings rates. Return matters, but contribution rate matters too. A person obsessed with beating the SP 500 by 2% while saving very little may underperform a person who simply saves far more into a basic index fund. This is a key point. There are three drivers of wealth: how much you invest, how long it compounds, what return it earns. Most people focus only on return because it is exciting. But savings rate and time can be more controllable if you want to retire faster. Do not only chase higher returns, save more, invest earlier, reduce unnecessary expenses, avoid debt, and then consider intelligent tilts. The order matters. Now, the ETF examples can help investors think about opportunity, but they should not distract from the foundation. Emergency fund, no high-interest debt, consistent income, tax-advantaged accounts, low fees, reasonable allocation, long time horizon, behavioral discipline. If those are not in place, a more aggressive ETF may not solve the problem. It may simply add volatility to an already fragile life. Do not use investment risk to compensate for poor financial structure. That is one of the most common mistakes. A person behind on retirement may feel pressure to take huge risk, but if the risk causes a large loss or panic sale, the problem worsens. The better solution may be higher savings, longer time horizon, better tax planning, and a realistic allocation. Higher returns are valuable, but they are not a substitute for a sound financial system. Now, let us bring the message back to the main idea. The S&P 500 is excellent. Trying to beat it requires accepting additional risk. There are ETFs that have historically outperformed by tilting toward growth technology, defense, momentum, semiconductors, or the Nasdaq 100. These funds may continue to do well if the forces behind them remain strong. They may also underperform if the environment changes. The investor's job is to understand the exposure, choose a role for each fund, size it properly, and keep investing consistently. Always be buying, but only in assets you understand and believe in for the long-term BTD. Buy the dip, but only when you have cash reserves, a strong plan, and the emotional discipline to buy what others are selling. This is how market cycles create wealth. Not because crashes are pleasant, because crashes transfer assets from the impatient to the patient. When everyone is afraid, prices can become better. When everyone is euphoric, prices can become dangerous. The disciplined investor does not need to predict every turn. The disciplined investor keeps buying systematically and uses fear as opportunity when the balance sheet allows it. That is the principle. Now, I want to end with a warning. Do not let the desire to retire faster make you careless. The idea of beating the S&P 500 and retiring 10 years earlier is powerful. It is motivating. It shows the force of compounding. But if you chase past winners without understanding risk, you may do the opposite of what you intended. The goal is not to maximize excitement. The goal is to maximize the probability of reaching freedom. Freedom requires returns, yes, but it also requires staying power. A portfolio that gives you good returns but destroys your sleep may not be right. A portfolio that looks impressive in a backtest but causes you to sell during the first crash is not right. A fund that has performed well but does not match your time horizon is not right. The right strategy is the one you understand, can fund, can hold, and can repeat. That is the real edge for most investors. Not secret information, not perfect timing, not chasing every hot sector. A repeatable system if you can get a little better return. And if you can do it with discipline, the compounding difference can be enormous. If you cannot, the S&P 500 itself remains one of the greatest tools ever built for ordinary investors. That is the balanced truth. Do not disrespect the benchmark. Do not blindly chase outperformance. Study the risk, choose your tilts, automate the process, keep reserves, buy through fear, stay humble. Let time do its work. That is how wealth is built in markets. Not by predicting the next decade perfectly, but by owning good assets, managing risk, and behaving better than the average investor for a very long time.